So if you bought the market right after the last major inflation report spiked,
Yeah.
you probably thought you were surfing this massive new wave.
Oh, yeah.
You saw that huge green candle on the chart, right? You felt the adrenaline, and you hit the buy button.
Right. You think you caught the bottom.
Exactly. But you weren't surfing a new trend at all. You were the bait. I mean, you were walking right into an ambush.
Yeah, quite literally.
So today we are doing a deep dive into the brutal reality of what's called the retail liquidity trap. Our source material is this really sobering structural analysis that explains exactly why retail traders just consistently get chewed up during high volatility news events.
Constantly chewed up. Yeah.
But, to understand the trap itself, I think we have to understand the battlefield it's set on. And right now, that battlefield is defined by central banks that are just severely clamping down on the global money supply.
It is, it's a profoundly hostile environment for anyone who is operating on assumption or, just momentum. Because if we look at the raw data from the analysis, the Federal Reserve is currently holding the benchmark interest rate between 3.50% and 3.75%.
Yeah.
But the crucial detail there, it isn't just the number, it's how they got there.
Right. The vote.
Exactly. The decision came from a divided 9-3 FOMC vote.
And, that division tells us a story right there. When the Federal Open Market Committee votes 9-3, that signals this fierce internal debate.
Oh, absolutely.
I mean, 3 dissenters mean there is a significant block within the Fed that either wants to, push rates even higher or maybe hold them longer than the majority. So the central bank isn't just sitting on autopilot, quietly steering the ship.
No, not at all.
There's active hawkish tension in the room. And the driver of that tension, according to the source, is the data they are looking at. Specifically energy-driven inflation and core PCE.
Right. So core PCE, which is personal consumption expenditures, that's the Fed's preferred inflation gauge.
Right, because it strips out the volatile stuff.
Exactly. It strips out the highly volatile food and energy sectors to try and show the underlying trend. But ironically, the overarching energy costs are, they're bleeding into everything else anyway.
Right, transportation, manufacturing.
Yeah, all of it. So it's keeping that core number stubbornly above their 2.0% target. And this isn't just an American problem either.
No.
The European Central Bank, the ECB, and the Reserve Bank of Australia, the RBA, they are looking at similar data and maintaining highly restrictive policies too.
So to kind of translate this macro tension into the reality on the trading floor, I mean, the markets are actively repricing the future. The source notes a 40% or I think even higher probability of further policy tightening before the end of the year.
Yeah, at least 40%.
And the immediate consequence of that fear, it's playing out in the bond market. I mean, we are seeing U.S. bond yields touch multi-year highs.
Yeah.
The 10-year yield is hovering near 4.74%, and the 30-year bond is touching 5.3%.
Which is huge.
Right. So let's unpack the mechanics of that. I mean, how does a 5.3% yield on a 30-year government bond actually alter the day-to-day liquidity in the broader financial markets?
Well, think about it from the perspective of a massive institutional entity, like a state pension fund or a sovereign wealth fund.
Okay.
Their primary goal is capital preservation with, a reliable return. So if they can park billions of dollars in a U.S. government bond, which is theoretically the safest asset on Earth, and get a guaranteed, basically risk-free return of 5.3% every single year for 3 decades, the incentive to risk that capital in a volatile stock market completely evaporates.
Right. The hurdle rate for risk just gets way too high. I mean, why try to squeeze, maybe 7% out of the S&P 500 when you can get a guaranteed 5.3% just for lending to the government?
Exactly the calculation they're making. So it creates this massive vacuum. Capital is literally sucked out of riskier assets.
Wow.
Yeah, it puts immense downward pressure on equities. It compresses the valuations of tech companies that rely on cheap borrowing to fund growth. And crucially, it drains broad market liquidity.
Right.
The total pool of available money actively moving around the daily markets just shrinks because the big capital is playing defense.
And when you drain the water out of the pool, I mean, every splash feels like a tidal wave.
That's a good way to put it.
Because of this intense liquidity pressure, we are seeing a dramatic shift in how currency markets behave. They aren't producing those clean multi-week trends that, retail traders love.
No, not at all.
Instead, we are getting severe range-bound whipsaws. especially in major foreign exchange pairs like the euro to dollar or dollar to yen.
Yeah, because the currency markets are hypersensitive to these yield shifts. When liquidity dries up, you get an environment defined by carry trade unwind risks.
Okay, let's define that mechanism for a second, because the carry trade is this massive unseen force in the FX markets that a lot of people don't fully grasp.
Sure, so a carry trade is essentially borrowing money in a currency with a very low interest rate. So historically, that's the Japanese yen.
Right.
And you use that cheap money to buy assets in a currency with a high interest rate, like the US dollar. So you just pocket the difference in the yield.
It sounds so simple.
It is until it isn't. Because when global central banks are all jockeying their rates and volatility spikes, those massive institutional carry trades suddenly become incredibly risky.
Oh, I see.
And when institutions rush to unwind those trades, meaning they have to, sell all those dollars and buy back the yen, it doesn't happen smoothly. It creates violent, sudden reversals in the market.
So we have a drained liquidity pool, violent structural reversals, and no clean trends, which brings us to the core of the analysis, really, the mechanism of the trap.
Right.
This environment is where retail traders are getting financially slaughtered during major economic releases. The analysis points out a highly predictable behavioral pattern whenever data like the Consumer Price Index, the CPI, hits the wire.
Yeah, and the anatomy of the trap relies entirely on human psychology reacting to algorithmic speed.
Okay.
Because the moment the CPI data drops, let's say inflation comes in hotter than expected, high-frequency trading algorithms instantly react to the headline. They execute thousands of orders in milliseconds,
Right.
which creates a massive, nearly vertical spike in price on the chart.
And this is where the retail trader sitting at home gets triggered. I mean, they see a massive green candle forming on their screen, their pulse spikes, the fear of missing out, FOMO takes over.
Exactly.
They assume this explosive move is the start of a massive new trend. So they smash the buy button, usually right near the top of that initial spike, because they're desperate to get in on the action.
And they're doing this in complete isolation, looking only at the immediate momentum without any top-down context of the broader market structure.
This is the part of the analysis that completely reframes how the market operates for me. Because the retail trader thinks they are jumping onto a moving train. But structurally, aren't institutional players actually relying on that exact surge of retail FOMO?
Yes, 100%.
Because large funds can't just dump $1 billion onto the market without cratering the price. They need an army of buyers to absorb what they want to sell.
It is cold structural predation. I mean, an institutional risk manager has a massive block of orders they need to execute. Let's say they want to sell a massive amount of the euro against the dollar.
Okay.
If they just hit sell on the open market, the sheer size of their order would drive the price down so fast that they would get terrible fill prices on the rest of their order. So to sell a massive position at a premium price, they desperately need a surge of buying pressure to act as a counterparty.
A liquidity generation event.
Exactly. Institutions view these news-driven spikes not as new trends, but as marketing campaigns to generate exit liquidity. The retail trader who is emotionally hitting buy at the top of that CPI spike is providing the exact liquidity the institution requires to unload their massive sell order. The institution's algorithm is literally sitting there with a limit order, just waiting for the retail momentum to push the price high enough to fill it.
The contrast there is staggering. You have a human being at a computer driven by adrenaline and the visual stimulus of a fast-moving chart, just throwing their capital at the market. And on the other side, you have an institution's cold mathematical algorithm quietly absorbing all that frantic buying just to fill a predetermined quota.
And the moment the institution's massive sell order is filled, the buying pressure is instantly overwhelmed.
Right.
The price stalls, reverses, and crashes back down violently. The retail trader's stop loss is triggered, or their account is liquidated, and the institution has successfully entered their short position at the absolute top of the market.
So if buying the momentum on a 5-minute chart during a news spike is essentially volunteering to be institutional liquidity, how do professional risk managers actually navigate this?
Well, they have rules.
Because they obviously aren't sitting on the sidelines, right? They are actively participating. The source material outlines this as a strict structural framework, starting with multi-time frame alignment.
Time frame hierarchy is the only way to filter out the noise. A lower time frame chart, so a 5-minute or a 15-minute chart, is highly susceptible to manipulation in these sudden news spikes.
Right.
By itself, a 5-minute chart is completely blind. Professional traders refuse to execute on a lower time frame unless it is strictly aligned with the upper time frame market structure, so specifically the daily or the weekly charts.
It's like the difference between a gust of wind and a river current.
That's a great way to think about it.
I mean, the 5-minute chart is a sudden, violent gust of wind blowing upstream. It feels powerful in the moment. But the daily chart is a 10-foot deep river current moving steadily downstream. If you throw your boat in the water and try to sail based on the gust of wind, you are going to get absolutely crushed by the underlying current.
That analogy perfectly illustrates the concept of institutional order blocks. Large institutions leave footprints on the daily and weekly charts.
Because of their sheer size.
Right, because their orders are so massive, they create zones of historical supply and demand. If the daily chart shows that the overarching river current is heavily bearish and price is approaching one of these massive institutional supply zones, a professional trader is already on high alert.
They know the trap is being set.
They know that any sudden 5-minute spike upwards into that zone during a news event is not a new bull market. It is just the gust of wind pushing the price up into the trap.
Wow.
So if you only look at the 5-minute chart, you see strength and you buy. If you look at the daily chart, you see price being engineered into a kill zone, and you prepare to take the opposite side.
Which brings us to how they actually pull the trigger. Rule 3 from the analysis outlines the execution framework and reveals that institutional trading is a business of intense, calculated patience. They aren't trying to predict the outcome of the PMI data before it drops.
Oh, prediction is a fool's errand in this environment.
Yeah.
Professional execution is entirely reactive and process-driven. They wait for the news event to occur. They watch the volatility spike. They literally watch the retail market get swept into the trap.
The analysis refers to this as liquidity sweep.
Uh-huh.
Let's break down the mechanics of a sweep because it's a term that gets thrown around a lot. But understanding what it looks like on the board is crucial.
Sure. A liquidity sweep is the deliberate pushing of price just past a very obvious level of support or resistance.
Okay.
Let's say there is a very clear recent high on the chart. Retail traders who are shorting the market will naturally place their stop-loss orders just above that high, thinking it's a safe place to hide.
Right.
But institutional algorithms know exactly where those pools of stop-loss orders are sitting.
Because a cluster of stop-loss orders from short sellers are technically just buy orders waiting to be triggered.
Exactly. They're buy orders. So during a news event, the institutions will allow or even encourage the price to spike just above that old high. It triggers all those retail stop losses, forcing them to buy, which creates a massive pool of localized liquidity. The institutions use that sudden surge of forced buying to fill their own massive sell orders.
Right.
So the chart will show the price piercing the high, grabbing the liquidity, and then instantly rejecting back downward. That is a liquidity sweep.
So the professional trader waits for that sweep to happen. They let the retail stop losses get triggered. And then what is their signal to actually enter?
They wait for a structural break on the lower time frame.
Okay.
Once the sweep happens and the price rejects, they drop down to the 5-minute chart and wait for the immediate trend to break in the direction of the higher time frame current. They need mathematical confirmation that the trap has sprung and the institutional money is now driving the price back in the dominant direction. Only then do they execute.
So they are reading the river current, they're waiting for the wind to blow the retail traders into the trap, and they only enter when they see the water start rushing back downstream. It is incredibly disciplined.
It is entirely built on process over prediction.
But, even with a perfect read on the time frame structure, executing in a market full of carry trade unwinds and hawkish macro tensions is still really dangerous.
Oh, very.
I mean, even the best technical setup can get blown out by a random, unannounced geopolitical headline. Which steers us into the final, uncompromising pillar of institutional trading discussed in the text, which is risk control and position sizing.
This is the foundation upon which everything else is built. Risk is the only variable in the financial markets that a trader actually controls.
Right.
You cannot control what the Federal Reserve Chairman says at a press conference. You cannot control how the algorithms digest a sudden spike in crude oil. You can only control the exact dollar amount you are willing to lose on a specific trade.
Let me push back on how retail traders perceive this, though, because the psychology actively fights the math here.
Yeah, it does.
During a massive CPI day, when a trader is convinced they have accurately predicted the market direction, they naturally want to size up. They want to put 10% or 20% of their account on the line to catch the big move and make a significant profit. But the analysis states that mathematically, if a trader enters a position without a fixed maximum account risk of 0.5% to 1.0%, they aren't trading, they are gambling.
They are mathematically ensuring their own eventual destruction.
Wow.
Because without rigid position sizing, you are entirely at the mercy of variance. The reason institutional desks enforce absolute risk limits of fractions of a percent per trade comes down to the unforgiving asymmetry of drawdown math.
The math of recovering from a loss. Let's walk through that mechanism because I think a lot of people fundamentally underestimate how quickly leverage can dig a hole that you can't climb out of.
Absolutely. If you risk 20% of your capital on a trade because you had, a gut feeling about the inflation data and the market violently whipsaws against you, you take a massive hit. If you do that a couple of times and experience a 50% drawdown on your total account equity, you now have half the capital you started with.
And here's the brutal part, right? To get back to your starting balance, you don't need a 50% gain.
No. You require 100% gain on your remaining capital just to break even.
Yeah.
You need to double your money just to get back to zero. And in an environment defined by 5.3% risk-free yields, hawkish central banks constantly tightening liquidity, and algorithms designed to hunt retail stop losses, generating a 100% return is a monumental task.
It's nearly impossible without taking on even more reckless leverage, which usually just leads to blowing the account entirely.
That is the death spiral. That mathematical reality is why institutional risk relies so heavily on that 0.5% to 1.0% rule. If you risk 0.5% on a trade and you get swept out of the market by a random spike, you need roughly a 0.5% gain on the next trade to recover. You are simply absorbing a business expense. You are still alive to trade the next setup. Survival is the primary objective. Profitability is secondary.
So to pull all of this together and distill the mission of this deep dive, whether you are actively managing your own capital or you are simply trying to accurately interpret why the global markets are reacting so violently to everyday news, you have to look past the surface-level volatility.
You have to.
High volatility news spikes are not reliable indicators of market trends. They are mechanisms engineered to generate liquidity. We are navigating a highly restrictive, low-liquidity macro environment. The institutions are the whales, and the retail traders chasing 5-minute green candles are the krill.
Exactly.
If you want to survive, strict mathematical risk control and a multi-time frame structural process must absolutely override the emotional urge to predict the news.
The environment does not forgive impatience, and it certainly does not forgive arrogance. You have to wait for the market to reveal its hand.
It requires a fundamental rewiring of how you perceive opportunity. But this dynamic between institutional size and retail behavior leaves us with a rather fascinating structural question to close on. We've established that institutional market makers heavily rely on the predictability of retail traders.
Right.
They literally require that retail FOMO during news events to provide the necessary liquidity to fill their massive block orders. It is an ecosystem built on the assumption that retail will always blindly buy the top of the spike.
It is a market mechanic dependent on a continuous supply of uneducated capital.
Exactly. So here is the question for everyone listening to mull over. With the rise of accessible algorithmic trading for retail participants and the vast amount of structural market education now available, what happens to the mechanics of the market if the retail sector eventually adapts?
Oh, that's interesting.
If the retail algorithms get smarter and refuse to take the bait during these liquidity generation events, if the trap stops working, who becomes the exit liquidity for the institutions?
That is the systemic paradox. If everyone learns to read the river current, the entire flow of global market liquidity would have to fundamentally restructure itself.
Yeah.
And figuring out who the new prey becomes in that scenario is, well, it's the multi-billion-dollar question.